Options confuse you? We're breaking down trades, time frames, expected moves, and whether you should automate or go manual. Let's jump into it after the bell.
Since Jason's not here, I think I have to be the one that comments on the dissonance between our two opening tracks.
Yeah. Right? I love that song. It makes me feel so happy.
I think I need to get a taller chair if we're doing these side to sides. I look a little shorter than you, huh?
Can't you do one of these?
No, this is as high as my chair goes.
Oh, I thought you had the camera's in the computer.
Yeah.
Well, we're just gonna have to get you a better camera, aren't we?
Yeah, I guess that works too.
All right. So here's the deal on today's topic. Okay. I'm going to tell you how this came about and we're going to riff on this. Okay. So this is a little bit more, I'd say relative to beginner, intermediate, advanced, probably more toward the beginner, intermediate part of the world. Definitely intermediate, I guess, in some spots. So the reason I brought these up today with us is because I've been answering some Reddit posts on behalf of, Tradier. And a lot of great questions. I got to be honest. So it's a lot of advice. What should I do, and how should I do it? That sort of stuff. And a lot of it centers on trade size and that sort of stuff and types of options. So that's where this all comes from. I picked the four kind of what I thought were the most rounding topics, and they are kind of you're new to the markets. What are the best things to consider in terms of making your first few trades? Should I be a long-term type of trader? Let's call that, an investor. A shorter term, let's call that a swing person. And then a day trader, which is in and out each day. Okay, that's number two. Number three, got a lot of questions about expected move calculations and implied volatility. So we can kind of chat about that a little bit, some themes there. And then the last one, Mark, near and dear to your heart, I think, automation versus manual in terms of your trading workflow. All make sense?
Oh, we got some good stuff here.
Good stuff today. So we're going to knock this down. Let's start with the first one, the beginner. Best trades to make as a newbie, okay? And I'm going to just turn it right over to you. There might not be a best trade, but I always lead in with, first of all, educate yourself. Understand the nuances. You don't have to understand all of the complexities of the minutia of second-order Greek, that sort of thing. We'll get to that eventually, but you got to have a firm grasp on the behavior of options, right? Is that fair to say?
Yeah, I mean, I was going to say that the first trade should be selling VIX calls, but
and tell us why. I love the answer too. It's great.
Kidding. No, I think honestly, the best way to first get into it is not a brand new idea, but the covered call. Because I think most people approach options from an equities perspective, right? You've got some gut about maybe what a stock will do, what the market's going to do, that it's a derivative of the equity. So, obviously what that stock is going to do is going to be a big part of it. And so putting in a covered call, regardless of what that makes sense is long-term or whatever, I think that gives you the best kind of 101, what's going to start happening to this option as time passes, stock moves, vol changes, etc.
Yeah, I love that. So the reasoning is, or some of the theory behind it is, people probably already own stocks anyway, right? So they have some sort of portfolio with equities that they like for whatever reason. And selling a call against some of those equity positions makes a lot of sense. It can generate some income too, right?
Sure. There are great reasons to do that trade. I think you've got to think about it, on a more strategic level, whether it's right or wrong, whether this vol is underpriced or overpriced, there's a lot that could go into that. But at the end of the day, I think you just got to get your feet wet. 100 shares of a small stock, you're not putting that much capital on the table. So, I just think that's a cheap entry point. And like you said, aligns with what you're thinking about with the equities anyway.
Yeah. And then you could see, how that option decays because, you're hoping that happens. You can also see how it behaves with the underlying stock moving up and down, gives you a little protection to the downside. generates a little income, and it can take you out to the upside, right? If the stock rises far enough. But as an investor / trader, you have the ability to roll that short call, right? So let's just touch on that real quick, and then we'll move on to the long versus short term.
Yeah, so if you're thinking about it over time, of course, if it stock's going through that, one of the common things would be to roll like up and out. So you've won in that trade already, maybe not as much as you could have, but stock goes up and you're shorting out the money call. That is going to be positive P&L. You can take that loss, put it out another month, there to another week or whatever your frequency is. So that's like the up and out roll. But then you can also roll if it's not going in your favor. So if stock goes down and you're short the strike that's out of the money and that's gone to zero, and before expiration you might roll that even down to collect a little bit more income. Depending on where your entry point in the stock is, those are some other considerations. But you can roll a winning trade or you can roll a losing trade.
Sure, absolutely. And what Mark means by rolling means it's just taking in that short call, closing it, right? That's the first part of rolling is you're closing one leg and you're opening a second leg. You can do that as a spread. So you can do that all at once, both pieces all at once. Much safer to do, so there's no leg risk to do it as a package. So you're just closing one leg, roll. When Mark says rolling out and up, that means out to another expiration. Up means up in strikes, and rolling out and down means down in strikes. And it kind of depends on a little bit of your perspective and what the stock has done. Has it moved up or down relative to the first trade that you made on it, right?
Yep, totally. Choice of underlying is key here. And especially for some early kind of like test trades, so watch what the option's doing. You can kind of not worry about the price of volatility so much and just think about dollars and cents for the 101.
Yep. Okay, good. So that's a great first great trade to make. We're not going to get into the second great trade.
The first trade is if you're going to pick a stock, I said it works in any stock, go for something liquid, go for a top tier name, go for, it can be low in dollar price or whatnot. But, if you pick something esoteric, then you're going to be, giving up a little bit more and it's not going to be as, educational.
Sure. Understood. That makes a lot of sense too. Liquidity is key. Okay. Let's move to point number 2. Long-term versus short-term options trade. Let's assume in this question that our new trader has graduated to step 2, got beyond the covered call and understands a little bit more about options, has developed an okay keen sense of credit spreads, debit spreads, maybe some other things. What's your feeling on where to place these trades relative to the term structure of the curve? And all that means is, what expiration cycle, how many days out to expiration is optimal in your opinion? I know everyone has a different opinion. What are your thoughts?
I think a good question to ask, and kind of the way I like bucket the world when you're approaching option strategies on the quote unquote buy side is this more like an investment style trades, sort of what you were hinting at with the long term, or is this more of what I call an opportunistic type of trade? Sure. And that opportunistic trade could be as short as a 0 DTE trade, or that could be in the couple weeks time frame, right? And generally, like the types of strategies that you want to use are going to depend on which bucket that sort of fits in. So, on those longer term things, we're talking about quarterly options, annual options even, or, perhaps that strategy might involve rolling something more frequently at a monthly level. Whereas that short term stuff, obviously we have the playground that is the 0 DTE markets, but even within the weeklies that are pretty liquid and listed, if you're trading at that interval, I think you want to be looking at, real or just generally different trading strategies. Sure. Those opportunistic spreads, whether they're credit spreads or debit spreads, momentum type plays, that sort of class of strategies. Yeah.
Yep. Makes sense. Yeah. My personal rule of thumb is I like to play, if I'm going to be the swing trader guy, meaning I'm not investing longer term and I'm not day trading. So somewhere in between, I like the maximum 60 days, preferable 30 days on in is my favorite. And that's me and my personality. I think I discovered I'm not really a good day trader as a retail person. I'm a much better, I'll call it a swing trader. So with some time for whatever strategy I'm doing to kind of, wiggle itself out and kind of, dry the wet laundry, as it were. So that's just me. I don't know if you feel similarly, but that's how I like it.
Yeah, I think, everyone has their sort of different niches in short term, or whether you want to call that medium term, that 30-day move. I think, like you say, that gives you 21 trading days for something to kind of wiggle out. If you're trading in the zero DTE space, like 50% of SPX volume is, then you want to be, capturing, small moves, like short momentum swings, and be really in and out with those kinds of trades. And I don't want to leave the final question, but that's the great opportunity for a trading bot or something that's algorithmic, is when you're really capturing those ultra short-term premia.
Yep. Love it. Okay, good. Let's move to expected move and that sort of thing. So I get a lot of questions on that. So let me lead in, and then you can give your crack at it. So expected move, there's a fancy math formula, first of all. We're not going to go over it now because I'm not going to share a screen and draw it on the remarkable, because I don't have the remarkable. Interesting. It's in the other room. So there's an expected move calculation, and there's one that can even take it down to how many days in the expiration are left, and give you that sort of expected move as well, right? So there's a fancy calculation. It's actually very easy. We will post that another time for you, okay? But generally, what I tell people is, if you look at the money straddle in any given month, it's an okay approximation of what the market making community with implied volatility is saying that move could be. Now, some of the things about expected move relative to options are, it does not tell you direction. Okay. It just tells you about that center point. You can move in either direction about that amount, right? The other thing, Mark, what's the other big tenet of that straddle? Anything that I'm missing?
No, I was going to say exactly the same thing, that, you can do all the fancy math that you want, but like the straddle, I have a blog post about this, cheap plug for the till. But I say that straddle is your hammer. That, like, if you only had one tool and you only could do one, you can go real far with a hammer, with the straddle. Use that to, like you say, price moves in either direction, or expectation of moves in either direction. So when you're setting your credit spreads or maybe debit spreads, like, you can use that as a kind of benchmark for what the market is expecting this stock is going to move in that amount of time. And
right. Yep. Yeah, and don't forget, when we talk about volatility in parlance, the way we speak about it is, it's trading at 20 vol. What does that mean? Well, it means that we'll just take $100 stock to make the math easy. If it's a 20 volatility, that means over the course of a year, right? It's expected to move 20% up or down 62.5% of the time. Accurate?
Yep. And, vol's great for pricing things in sort of, comparative terms, and what this, month is trading versus that month, and, relative, values and stuff. It's great at, but, like, the end of the day, a dollars and cents move that the straddle provides, which is obviously just a converted vol number into an options price, that is a very intuitive and accessible way, I think, to think about expected move.
Yeah, 100%. And like I always say, it's like dropping grenades. Just get close. You're not trying to solve brain surgery here with these numbers. Get it close, and the straddle's great. And just for people who are really new at this, all the straddle is that at the money call and put. Take the midpoint of those two markets and add them together. Add the call midpoint, the put midpoint of the at the money strikes, and you're going to come up with a number. That's sort of the expected move. And again, I say sort of because it's not exact, but it's pretty darn close, of what the community is thinking that move could be. Right? Safe enough?
Yep.
All right. Perfect. We're going to leave Jason's favorite topic for later, implied versus realized vol. We talked a little bit about that last week. Let's move to automation versus manual. I do get a lot of these questions too. Should I be using bots, et cetera, et cetera? I know I'm going to let you talk about this one. I do have an opinion on it. I love automation. I especially love it for the retail trader. I love it for the Lex retail trader because I spend about 30% of my time not staring at the screens, doing something else. And I always miss things if I'm not automated. The other great thing, and you probably touch on this, is automation completely eliminates emotion. And emotion is the bane of a retail trader. It is the utter worst characteristic you can possibly have. So, having said that, knock it apart. Have at it.
Yeah, I think any degree of automation, for processes that you are appropriate, like it just makes your life easier. And I was mentioning before, there are sort of the two camps: the investment camp and the opportunistic camp. And on the opportunistic camp, it can see things that you're not necessarily seeing, that you can be away from your desk. It can capture that tick. It can execute as soon as conditions X, Y, and Z are met. And those are all things that are difficult and slow and tedious for humans to do. So for capturing those sort of short-term moves, whether it's getting into the trade, out of the trade, you can automate different legs, right? You can automate an entry, you can automate an exit, you can automate both. And they all have their pros and cons, or depending on what you're trying to get at. As you start to go longer term too, right, to your point about emotion, having a systematic, role or allocation or rebalance or whatever that, long-term trading decisions that you're making, automation helps too, not because it's difficult to make one trade per quarter, but because it's, that trade is made whether you're feeling X, Y, or Z about the market. So, getting that out of the way and having like a systematic approach to, the long-term investments makes a lot of sense too.
Yeah, I think I love that. So, and I agree with all that. I think one of the little things that I was told recently from a really great retail trader, and he's a mentor, was that he's already figured out his exit to the trade before he even gets into the trade, which I love when you think about it, right? I don't think we as market makers really thought too much about that, other than just kind of warehousing inventory and managing the warehouse. It's great to buy something for Edge and sell the same thing for Edge. That's wonderful. That's not realism. But he already has the exit planned, and it's whatever it is, whatever his method is, he has that plan. So I guess my question to you is going to be, how do you like the OCO version of a trade? And I just use that as one cancels other, to have a profit target and a stop loss, hope you don't get there kind of target as well. Set it, forget it, be done with it, move along. Same kind of concept is generally, or no?
Yeah, no, I very much agree with that idea of knowing what your exits are, and whether it's specifically customized to that trade. Like you're looking at a swing trade over a couple of weeks, and you might have your stop loss in mind. That's one way to think about it. Or whether like taking advantage of those order types where you can truly send in your closing order as soon as you get in. Having that in place gives you a lot of advantages too. So framing that the exit, I think, is particularly with opportunistic strategies, right? You're not but same with long-term stuff, right? You could say if Apple hits 500, I want to sell.
Yep, for sure. Okay.
I could sell Apple.
I think I in the world of AI that we're living in now, I don't think we're getting farther from automation. I think we're getting just darn near closer. It's you can see that light bulb shining brighter, I think, right? So
oh yeah, I mean, look at all the algorithmic options you have with order types of Tradier, right? Like the OCO is a great way to get in and out, and it just puts your order one step closer, one fewer point of failure.
Yeah. Have you noticed, I haven't had this question yet, but I'm sure I'm going to get it. Have you noticed any of the AI software that's out there that can actually read a chart and give you an analysis, or I know nothing's 100%, but a prediction of what the analysis means relative to the stock price? I've seen a few things like that. I've never tried one. I'd love it. And I've seen them where you can take a picture of your phone of a chart pattern, and then it says bullish, bearish, or neutral. I'm like, wow, that's cool. I don't know if it works, but pretty neat.
Wow, no, I have not seen anything like that. That's pretty interesting.
Yeah, that would help me a lot, actually. All I need is direction. I'll figure out the strategy. I've figured that one out.
I don't know if I necessarily believe in technical analysis, whether it's an AI or whether it's a person doing it. I know people can. But
I know people swear by it. I've never ever been good at that and never done it. We didn't have to, but maybe that's why I'm a little skeptical. I'm gonna throw in a bonus topic. You ready?
Hit.
All right. Sizing. Size matters, right? What's your thoughts on how you size your positions as a user? And I know it's, my feeling is got to have something to do with your equity and your risk management tool, and what amount of risk percentage wise you're willing to take per trade, per strategy, however you want to look at that scenario. What are your thoughts on sizing? Because I think a lot of people get blown out because they're doing too big a size relative to their equity.
Yep. I think, if we're talking at the truly 101 level, your very first trade, a one lot is the right answer, no matter how big your balance is. There's kind of no point in, putting any more out there. You can quickly size up if you get the hang of it, if you catch it. There's always more size to be had later. But digging yourself out, it becomes geometrically more difficult. So 101, one lot, dabble very small.
Yep.
When you start thinking about, again, to this opportunistic investment decision, the long-term investments kind of are a big portfolio allocation. So there you're talking more about, relative percentages of stuff is probably more the question with that. But I think for people that want to trade on the short to medium term, thinking about that sizing, you have to think about that size overall. How much of your, big picture pie are you risking? How big is this brokerage account relative to your 401k, all that? Sorry, as an investment advisor, I have to say all that. But thinking about if you're just looking at your trading stack, then, which I think, once you determine what your, stack is, then keep it small in the beginning, single digit percentages of capital. I think, unless you become really confident in something, it's hard to dig yourself out. So I think always keep it smaller than you think.
Yeah. I like that. Someone asked me to throw a number at it. And I said, look, okay, let me think about it. And I came back with, I thought about it. My first answer was 2 to 5%, but I was too wide of a market. So I said 3 to 5% of your equity on any one strategy. And I don't always say strategy. It could be a covered call. It could be an iron condor. And that's the amount you're risking, your max loss relative to your equity. It's a nice number. It's not going to get you in trouble. And it scales if your equity grows. You obviously can start, doing a little bit more per trade. And look at it. It's a safe number. It's not going to blow you out, and it's something to lean on. There's no science to it. I can tell you that right now. It just feels right to me. And if I got to think about it and put science to it, I will. I'll go back to the the back of the napkin and figure it out. But I think that sounds good to me. I don't know. Is that weird? 3 to 5%, or is that too high?
It's actually very reasonable. That's like roughly where I would say. Also, you start to risk 10% on a trade, and especially in a credit spread environment or debit spread, and you're losing 10% of your account, that's, a big chunk. And how many, steps to the plate do you want to be, or how many at-bats do you want? Like, if the odds on your strategy are such that, you're going to have 3 and 4 losers, if you're risking 10, 20% on a trade, that, is very destructive very quickly.
Right. For sure. All right, cool. Yeah, I'll have more of these. I get them every day, so we'll throw a few of these. We'll sprinkle these in on our Traders Workshop Day. All right, good. We got to run, but Mark, tell them where they can find you.
You can find me at harvestedfinancial.com, or if you want to read my scintillating blog, The Till, is at thetil.substack.com.
Yeah, and I love The Till. Trust me, the great graphics. I know that's automation too, so love it. Very good. I love reading your stuff. Very, very snarky too sometimes, which I like.
And plenty of automation power. I know those were some subs, but with our friends at Peakbot, so running automated strategies with them too, which you can find more at my website.
Awesome. And don't forget to follow us at Smart Options Trader on YouTube. We also are at thehub.tradier.com. Make sure you subscribe to some great new things coming along. We're doing some educational series there. You have to be a subscriber. It is free, so don't worry about that. But only subscribers will have access to that educational series. And I think Mark's going to be kind of a guest teacher in some of those episodes along the way. So we'll see what happens there. Otherwise, I love giving my email out because I like getting emails. If you want to do a private session on Tradier Pro, our desktop, feel free. email me at lex@tradier.com, and I'd be happy to show you the ropes on a Zoom call. Anything else, Mark?
Happy trading.
Happy trading. All right. See you next time.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.